Holdings stock has underperformed the S&P 500 index, rising just 9% with the S&P up closer to 17%. I've had this stock rated as a hold all year in 2025, pointing to valuation as my main concern. But what about 2026? Do I think this is a buying opportunity for investors? I'll answer that question in this video, reviewing the company's longer-term performance on critically important financial metrics and revisiting my discounted cash flow valuation and sharing with you the market multiples valuation on forward PE and forward price to OCF. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. ARM Holdings has increased its revenue from $2 billion in 2021 to $4 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 20% during that time. Furthermore, the management team has told investors that they can confidently expect to grow revenue at roughly 20% for the next 2 to 4 years as well. The company's gaining market share over the x86 infrastructure for data centers, and the increasing computing devices worldwide and the Internet of Things are requiring increasing shares of data capacity and computing capacity in devices. ARM's specific architecture has the biggest advantage in power consumption, and power consumption is becoming one of the most important things when you're building a data center optimized for AI, because artificial intelligence consumes a lot more power compared to previous generation technology that operates based on CPUs instead of operating primarily based on GPUs. So all of that is making ARM's business model that much more attractive. And remember, the company invests in research and development. It doesn't do any of the manufacturing, which allows for a lucrative business model and allows for the company to sustain competitive advantages by focusing exclusively on developing the technology. Now, that being said, it hadn't been doing a good job in generating returns on invested capital. It was heading in the opposite direction from 22 to 24, down from 30% to 3%. But it has since improved this, improving from 2.9 to 12.8%. The company has been and continues to invest in the technology because they're seeing such good returns. They're seeing such good demand from marketing, demand from their partners to purchase their technology. So they want to invest and capitalize on their lead. Of course, they're gaining most of their market share against Intel, which is losing significant market share in the categories where ARM is operating. And we see a similar story with its cash flow to sales ratio. It's been on a downtrend, falling from 61% in 2021 all the way down to 4.5% in the most recent trailing 12-month period. The most significant reason is ARM is investing, growing its employee base, growing the talent base in order to fulfill the demand placed upon it from participants. They want ARM to continue to innovate and incrementally improve the technology because the partners are investing and want to spend money in the categories. And so ARM is investing so that in future years, they'll have the technology to keep up with the incremental improvements in their partners' ecosystem. Of course, valuation has been my primary concern for ARM because overall, I like the business. I like their competitive advantages. I like the business model, the asset-light business model, but the valuation has been rich. And even to this moment, it's trading at a forward price to earnings and price to OCF of around 70, which I think is rich for a company that is growing revenue at 20%, which is solid, but does 20% growth with cash flows and returns on invested capital not demonstrating improvement is not that great in my view. If it was 20% revenue growth coupled with improving margins and seeing a trend line of improving margins and improving cash flow, I would be more impressed. But it's generating 20% growth, but it's having to invest so much in research and development, so much in talent, that it's not improving the operating margins or cash flow margins just yet. Now, in future years, it's likely to do so as these investments bear fruit. But as it is now, we haven't seen very much improvement in those critically important metrics. Furthermore, I calculated a fair value based on my proprietary discounted cash flow model, and the intrinsic value per share came to $83.50. The current market price is $137. So, in both valuation methods, whether I'm looking at the market multiples method or whether I'm looking at my discounted cash flow method, it points to an overvaluation in ARM Holdings shares. Now, that's due to the fact that it's an excellent company with great technology that's gaining market share, that's benefiting from a strong tailwind. It deserves a premium valuation, but I think that premium is overdone. And so I will be reiterating my hold rating for ARM Holdings for 2026. I updated my rating here on December 2nd, rating the stock as a hold. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.